Hello, welcome to this February edition of Monthly Views. Let's quickly get started. So, the very interesting question came in, at least I think last month, and I've been sort of sitting on it, not being able to, you know, not getting the time to actually address it. So, let's spend some amount of time trying to understand this. So, three questions are related. Uh, how to study the cycles in Indian markets, how to spot sector rotation and study the upcoming long term trends, and how can we study more about cycles which can help us study the upcoming investment themes. Okay, so first, I think before I start, one of the best books you can read on cycles is the one by Howard Marks. I've just forgotten the name. It just popped out of my head right now. I think it's called Mastering the Business Cycle or something like that. It's by Howard Marks, and then there's another book I think by Ed Chancellor called Capital Returns. I might be wrong with the author, but the name of the book is Capital Returns. I think that's also another very interesting book on cycles. So you could read both of them to get a reasonably good understanding of why and how cycles play out. Okay, so with that, let's get into how do we study cycles. Now, first thing is I am not an expert on cycles. There are few people who specialize in tracking and understanding cycles, but very few who are really good at it. I try to understand, I try to track. I've been, last few years, last at least 2 3 years, I'm trying to get better at it. uh, so I'll tell you what things I do and what are the things that I think makes sense in trying to understand cycles and how to play them. The first thing is, whenever you're talking about cycles, we're talking about macro. We're talking about the broader theme. So you need to track the larger, broader economic indicators, sector indicators, right? What is happening with the overall country? If you're for example, tracking, say, steel. So what is happening with the steel sector in India, abroad? What's happening with steel prices? Who is the biggest producer? Who are the larger consumers? So on and so forth. And this is not only uh, with relation to steel, right? It could be anything. It could be autos, it could be metals, it could be even you know so-called non-cyclical sectors, like, say, for example, paints, right? The point is that what I have realized is there's nothing called as a non-cyclical sector. Every sector goes through cycles. Some sectors go through what I call very long cycles. So some sectors go through cycles which could be decades long, so 10 years, 15 years, 20 years for a upcycle to be there. In fact, typically, if you see bond markets or currency markets go through cycles which are sometimes which run for 30, 40, 50 years, right? So that's something that we need to be very careful about. uh, Second thing is, every sector has some key numbers uh, that needs to be tracked. So for example, you look at, let's take, say, banking sector. So you can keep a look, you can look at advances, you can look at uh, NPAs. So these are things that you need to, gross NPAs at the overall level across banks. Uh, you can look at asset growth, etc. So every sector, you can look at NIMs, net interest margin. So those are things that you will keep track on. If you're looking at, say, retail, you look at sales per square feet, etc., or same store sales growth. These are things you will look at. And then you need to keep track. For example, if you're looking at auto, you look at month by month, the dispatches, what is happening. So this will give you a reasonably good sense of what is happening. Then obviously the next thing is, you need to be completely updated on news and events relating to that sector, especially when you are looking at uh, any news that will impact that sector, any news that will impact the demand or supply equation in that sector, right? Whether it is through government regulation, whether it is through newer technology adoption, any geopolitical events, right? So there's a Russia-Ukraine war. How is it going to impact steel? How is it going to impact autos? Right. So is there an upstream or a downstream impact? So those are things that you need to understand. Where does it impact the supply chain for a particular event? The next thing is, when you're looking at companies within that sector, I think what one financial number that is very very useful is looking at the operating margins. Now, typically in a cyclical sector, you will find that operating margins typically have a lower end and an upper end. So, for example, a particular in a particular sector, the margins may oscillate from say 10% to 20%. Now, in bad times, the margins will compress down to 10%, and in good times, it will go up to 20%. Now, when the uh, margins have come down to 10%, and it starts to pick up from there, starts to when the numbers come in, and it's quarterly numbers where you're seeing 1 2 quarters where the numbers have started going up, management may still actually be a bit tentative, management commentary, that is a time to start nibbling and start buying. Peak margins is actually an extremely bad time to buy your ad, simply because that is a time when everything is hunky dory, all the news that is there is positive, and you will feel that there's nothing, this is going to be perpetual, right? The cycle will never turn, and then eventually the cycle turns. And I've seen this over and over again for various sectors, whether say sugar, paper, graphite, steel. Every time you'll get a new story where somebody will say that this time it's different, this time it's going to last longer, uh, so on and so forth. But it never happens like that. It sort of mean reverts back to the lower end of the margin again, and again exactly the same thing keeps happening. So there's this oscillation that keeps happening between the lower end and the higher end of the margin fronts, margin extreme. So good time to buy is when you're at the lower end of the margin, and then patiently wait till you get to the higher end of the margin. So that's another way to look at the uh, how to play cycles. Another way which I have been using also extensively is to look at technical indicators, technical charts, when you momentum indicators. When you see that number of stocks coming on your screen, especially a momentum screen or a technical screen, uh, where you see, even a simple screen like say last 1 month, average. So I don't know if you will be able to see this. Just let me give it a shot. Let's see if you can see this. Just give me 1 second. So, for example, this is the sectors that are there. I'm looking at this in investing.com. So these are, say, for example, the Nifty indices, right? And if you go to performance, you will see a daily, weekly, monthly, and just sort on this and see that okay, IT, auto, FMCG, they've been doing well in the last 1 month and year to date. So basically, that's about 1 month. Last 1 year, just look at which ones have been doing well. So PSU banks, FMCG, etc. So this will give you a sense in terms of which are the sectors that are looking, which are picking up. So typically, the 1 month is actually a very good indicator, which tells you that then you can drive deeper and see okay, uh, what is happening. Then go back and look at the margins, etc. That the other things that we talked about. See the management commentary that I spoke about. Okay. Uh, so chart patterns, indicators, simple price momentum for different sectors will give you a reasonably good sense of which sectors are looking good. Then the next one is, you need to uh, read research reports, industry reports. These are freely available most of the time. I think there's one very good website called ibef.org. It's a very good website. There's a lot of material on individual sectors, industries in India, and you can get a very good, sort of overview. In addition, just simple broker reports that you get from time to time on different sectors, updates on different sectors, they are very useful in terms of understanding. So don't go, when you're looking at a brokerage report, don't look at the buy sell kind of recommendation. You look at the data points, right? Don't look at what their opinion is, look at what the data points they're giving. That's the way I use brokerage reports, and I found them to be very useful, right? Because a lot of times some of these large brokerage houses have a lot of people on the ground who are doing the legwork. Plus they have connects with industry experts, they have connects with management, where they are able to collate a lot of information. So use them as your benefit, to your benefit, and get the information, get the data points from there. And lastly, I think most importantly, please understand that looking at long term trends is not an exact thing, right? You're never going to be completely right. So you will always need to monitor what is happening, and then you need to keep updating and adapting, right? Sometimes you'll see, sometimes you'll find that, just for example, we looked at IT, right? So we saw that IT has started, maybe doing well as a pack, and then you've taken a bet on, say, one stock or two stocks, or as a basket, and maybe you need to keep yourself updated with the results and what is happening in that particular industry, that particular company, as well as the industry overall, right? So this is the way I do it. If there is a better way of doing it, I'm open to sort of understanding that. uh, but in general, this is the framework that currently I am using. The next question, I think, I probably received more than 50 emails from all of you, and this is the first time. I find this very interesting, because last few years I've never received a single email probably on union budget. This time so many people came back asking about what are your thoughts on the budget. I have no thoughts on the budget, simply because budgets in India are basically driven to frenzy by the media. If you think about it, just take two deep breaths and think about the last budget that you remember. My guess is you will never remember any budget. The only budget I remember, and I was probably too young at that time, but only budget I remember, in a way, having read about it later, is the 1991 budget, where India sort of opened up and freed up the economy. That was the only budget which made a difference to the way we did business in India. Everything after that, so pretty much the last 30 odd years, all the budgets have been just tinkering here and there. So they have been complete non-events. The need for making budget an event is because, you know if you are the producer of a 24 by 7 news channel, you need something to feed your audience. So this has become a huge talking point. They'll get hundreds of experts, or people pretending to be experts, and they'll come in and uh, give lot of their thoughts. So 1 month or 2 months before the budget, you will find hundreds of people writing about their wish list. I used to, maybe 5 years, 8 years back, I used to read them. Now I completely, the moment I see budget wish list, I just completely, jump to the next article. Simply because this is somebody's wish list. I can wish for anything. I can wish, that capital gains is going to go to zero, short term, long term, everything is going to go away. If I make some profits, government is going to give me equal amount of money as as a cashback or something. I mean, I'm just talking through my head. The point is that most of it is completely irrelevant, right? The budget is basically an exercise in terms of keeping the books of the government in order, it gives you an indication of where the government is going to prioritize its spending. Last at least 10 years, right? I mean, not even that, even before that, maybe the last 10, 15, 20 years, most of the time you are already aware what the government's priorities are, whichever government is in power, right? And more or less you will find a reflection of that same thing in the budget. So there's nothing that is dramatically new that you come to know on the day of the budget. The only interesting thing for common people like us is what is going to happen to the income tax slabs. The last few years, I think that has also sort of become stable, and so nothing really changes. And also with all this, service tax, etc., going out and moving into the GST, where the GST Council has purview. There's no announcement in the annual budget, so hardly there's anything new which happens in the budget. So other than just having a confirmation of the government's priorities, it is mostly a record keeping exercise which we should completely, maybe spend 30 minutes on and then move on, right? So that's in a nutshell what my view on the budget is. Okay, so now let's go on to some of the interesting tweets that I had done over the last month, and let me share some context, etc., on some of those. So we've been talking, I mean, hearing a lot about what is going to happen to US, UK, Europe in terms of recession, right? And this is an estimate that has come out, and here it says that basically, other than UK, no other large country is going to go into recession in 2023. And if you look at what is happening in the US and mostly also in Europe, you will see that that is more or less correct, right? US economy seems to be pretty strong. Job growth is fairly good. It's just that factor is inflation is a factor, and my guess is inflation is on its way down and it's going to stabilize. So this whole fear mongering about recession, etc., is going to go away after a few months, maybe another month, 2 months. People will realize that it was not as bad as it was made out to be. In this same context, let me remind you of another set of fear mongering that was happening 3 4 months back, which was that Europe is going to freeze to death because in the winter Russia is not going to give them gas and oil, and Europe is going to be in really bad shape. Did not happen that way, right? I mean, a lot of, again, human emotions, or the way it is portrayed, goes through this huge cycle of oscillations from mania to depression. So that cycle of to and fro keeps happening, right? It's very, very interesting that we are now in a place where both India and China, after Chinese, opening up, are going to be the main drivers of the global growth in the next 1 to 2 years, and we should position ourselves and our portfolios accordingly. This is, like I said last time also, this is now not the time to be afraid and get away from the market. This is now the time to uh, sort of hunker down and slowly, steadily keep investing. The next point, okay, so about the budget, this is the only one point that I found interesting in this year's budget, uh, was that the the P notes, right? So basically, FPI, FII money flowing into India has been given a sort of indirect route through foreign banks that are going to be registered and operating out of the gift city. So in say 3 4 months, 6 months, we need to keep monitoring this and see if there is a significant, if this becomes a significant you know channel for FII and FPI money that is going to come through. Because with P notes, the two things which happen, there's this tax advantage, as well as the identity of the person or the group which is buying is is sort of not, they don't need to sort of come to the forefront. So this could actually end up creating a significant amount of liquidity inflow to the market. So something that we need to keep monitoring. So now this is very specific case of Dixon. Now, why I pointed this out was, Dixon is a company that I was following. I think they're doing actually a very interesting job, and this is kind of business that has very good scale, scalability and scale advantages. And other than valuations, I think Dixon is a business that I like. Now, the point here is not about the business. The point here is about the fact that even the management, right, does not know how the future, is going to play out. So Dixon started the year with a revenue guidance of about 17,000 crores. After the first quarter, it reduced it down to, I think, 15,000 crores. And now it has revised it down to around 12.2 to 12.7. Right. So basically, from a 65% annual growth, you're down to about 20%. Right. So what I'm trying to, sort of emphasize here is, we should never be very, very sure of two things. One, we should never be very sure of our own analysis, and especially when it is related to forecasting. And we should never take management guidance as sacrosanct, right? Because nobody knows what is going to happen in the future, right? So that this is a very, very good, current example of not taking yourself and management commentary seriously. The second tweet was about, how when industries change, right? So what is happening? There are few industries which are going through transformation. So I'm calling them the transformation economy. So what are the parts of the transformation economy? The biggest is mobility. In mobility, you have, where we are seeing automobiles moving from ICE to EVs and alternative fuel. We are seeing transformation in power sector, where again we are moving from fossil fuels, and to renewables and to green energy. And we are also moving in the telecom space from 2G, 3G to 4G and 5G. Right. So these are three of the major transformation economies where there is large amount of capex. There's large amount of money that is going in, and there's the probability of disruption of current businesses is significant. Now, in this space, if you look at Maruti, right? Now, Maruti is obviously a huge player in the Indian automobile, in the car sector, private vehicles, probably around 50% market share. I used to be a Maruti loyalist, started off with a Maruti 800, and then sort of migrated to three of Maruti's cars. And but what I found is that they have, because of their dependence on Suzuki for technology, they've got a sort of head in the sand kind of a mindset, where because Suzuki hasn't invested in EVs or in any form of new technologies, Maruti is falling far behind, and they're trying to make it up by making excuses and things, saying things like, we are going to focus on hybrid, we're going to focus on CNG, etc., etc. Now, all that is good. The point is that if the whole world is moving towards electric, right, the ancillaries, the setups, the service of cars, etc., is going to go towards electric. You will have electric charging stations set up more and more, and then the migration, it's going to be like a J curve. Suddenly you will find the entire thrust moving towards electric after a few years. We've already seen that building up now, right? And to bury your head in the sand and say that we will not do electric, or ceding leadership to your competitor is something which is, in my opinion, something that was avoidable. They with the might and the size of Maruti, if a Tata Motors could do something like this in terms of EV adoption, why did Maruti not put in money into R&D and come up with something of their own? I'm still not really very sure of. And in this context, I think Charlie Munger's quote of I think that one should recognize reality even when one doesn't like it. Indeed, especially when one doesn't like it, is very very apt. If you don't like the reality that vehicles are moving towards electric, it is more important for you to recognize that reality, right? It's very very important. So again, the last word has not been said on electric or on CNG, and maybe 10 years later we will realize that moving to electric was a disaster. There are challenges in electric vehicles, of course, in terms of elements for batteries, etc., etc. But that's a topic of discussion for another day. But the point is that if the world is moving towards electric and you don't have a scheme of doing of getting onto the bandwagon, then you are going to be in trouble. And then the last point here was just to look at MSCI India growth and MSCI India value. And what we've seen is pretty much, and this is just an example that I picked up from one of the brokerage reports, where they've done this comparison for the last 6 months, I think October onwards. But again, if you look at decades, like 10 years, blocks of 10 years, you will find a similar pattern recurring, right? At one time, you will find growth doing well. Uh, at other times, you'll find value doing well. At some other time, you'll find quality doing well. At some other time, you'll find momentum doing well. Now, very rarely will you find all of these doing well, right? So most of the time when say momentum is doing extremely, so momentum is something where loosely defined, anything that does well it could be momentum, so I'll keep that aside. But if I look at growth or value or uh, quality, etc., as factors, it is important to have a diversification in terms of strategy. So that is one of the main focus that I have had over the last few years, as since I started doing quants myself, because that this whole idea of having a multi-style approach has been sort of ingrained now into my head, because that gives a more smoother equity curve. Now, what do I mean by a smoother equity curve? It means that the portfolio value rise is much smoother, right? At one point in time I may not get the best returns, because the best return obviously will go to the style that is the most dominant at that point in time. But I will also not do really bad, which is the outcome of following a strategy which is completely out of favor, right? So for example, now quality is sort of out of favor, so most fund managers or investors who follow the quality style of investing are getting beaten, black and blue. And it is not no fault of theirs. They were getting the benefit 2 3 years earlier. We had a run of quality where quality factor outperformed everything else. Now it is where value is outperforming. So once we understand, so this is another thing that we need to understand, like sectoral analysis, style analysis is also something which is there. So which style is in favor, and then if you are able to adapt to that style, or if you have multiple strategies, then sort of use all of them and then allocate accordingly based on which style is more prevalent at the current point in time. With that, I will close for today. Thanks for sending in your questions, and thanks for patiently listening to today's talk. Please do keep sending me your comments, feedback, and your questions. And hoping to meet you again soon.